Today we're diving into one of the smartest principles in stock market investing, diversification. It's easy to get excited about a single stock or one hot sector, but putting all of your money in one place can be risky. Diversification in the stock market is about spreading your investments so you're not depending on just one company or industry to carry your financial future. Which begs the question, can the stock market be a good long-term investment?
Absolutely. I think it's one of the best long-term investments. You don't want to necessarily be in just one specific stock because you could be retiring next year and that stock has a bad year. But if we look at, those ETFs, mutual funds, a pool of stocks, they're all working together. When one's down, the others could be up to kind of help balance everything out.
Our advisors agree. The stock market can be a good long-term investment and diversification is key. But why?
Yeah, you don't want to have all your eggs in one basket. I know it's fun when you're in one stock and it keeps going up, but it doesn't go up every day and no stock's ever gone up forever. There's only a certain number of stocks, a very small number of stocks in the S&P 500 that have been there for 50 or 60 years. So that means they were good and then they weren't. So I do see, though, people that have way too many stocks. They have their own mutual fund. Matter of fact, I was watching Fast Money with Cramer the other night, and some lady called in bragging that she had 86 different stocks. And Jim Cramer rolled his eyes and said, "You don't have stocks, you have your own mutual fund." It's impossible to keep track of more than 10 stocks. As long as it's green, you're still doing okay, but green is a good time to lock in. I always say you're not up until you're out. So you say, I'm up, coach, I'm up in this stock. I said, well, have you liquidated it yet? No. I said, well, you're not up until you're out. What do you mean? Well, it's fun to look at it on paper. You're up. It's a paper gain. The old game and gimmick back in the day, when you go see your broker and say, the stocks you recommended to me are down. And the broker would say, oh, don't worry, it's just a paper loss. Hold it long term, everything will be fine. Because they're making money every quarter, they keep your money there. Here's a good secret that I've used over the years, and I really do practice this one. So let's say you buy a stock at $10 a share. Let's say you buy 100 shares, $10 a share, and it goes to 20. You sell half of that stock at 20. So now you still have 50 shares, but your net cost is zero. You are playing with the bookie's money. Therefore, it really doesn't, you want it to keep going up, but if it goes down, it's not going to put you out of business. It's not going to make you broke because you didn't lose any money, ever.
Diversification is key, and there are any number of ways to diversify your stock market investments. Whether it is by individual stocks, sector, geography, asset class, and more.
Yeah, the stock market, when we say the stock market, we just assume that all stocks are the same. But there's some stocks that invest in real estate. There's some stocks that invest in power, the utility companies, water, gas, the things you're going to need every day. There's even one that is a mutual fund, which is a collection of stocks. And that's what I recommend. But instead of diving into individual stocks, if you have under $500,000, you really shouldn't be doing individual stocks. You should be playing around with mutual funds or ETFs because it's a basket of stocks in the sector that you like. So you pick a sector you like technology. And then instead of you having to be the one going to interviewing all the CEOs of those companies and interviewing all the supply chain CEOs that supply that company, you trust the mutual fund company or the ETF company like Vanguard or Fidelity to have done all that work. Now, everyone says, well, my neighbor said this is a good stock. He knows somebody. So then you jump into the stock market because your neighbor said he had an insider tip. No one really has insider tips, by the way. And by the time you hear about it, it's too late. We're just little people down here. The big billionaires and all that, they may know what's going on. Congress, now that's a good little secret here. There are some mutual funds out there, or there's some stock picking places that you go and what they do is they research where Congress is buying, like the insider trading, like what Nancy Pelosi knows, and like what all the Congress, whatever they invest in, they have to disclose. So if Congress has been investing in it, maybe they know something. So there are some people who basically just invest in whatever Congress does. Now, if you watch some of these TV shows, like what Cramer will use, and he gives a stock tip out, a lot of times the stock will go way up after he talks about it, but then during the next day or two or week or month, it ends up lower than it was when he talked about it. So nothing wrong with having a gain if you're playing that fast money, I call it, because you need to get in fast and out fast. But if you have a profit, lock it in. Make a little money. No one's ever gone out of business when they have little gains.
Yes, there's a lot of strong evidence showing the long-term power of the stock market as a wealth-building tool. But before you jump in feet first, make sure you're aware of the common mistakes people make when it comes to long-term investment in the stock market.
basically, your worst enemy in the stock market is yourself. If the stock's going way up, that's probably the worst time to jump in and buy. Because if the stock's already way up and it's going up like crazy right now and you jump in and buy, when you buy, what are you buying? You're buying somebody else's shares. They bought it here, they're up to here, they're selling to you. Because the higher it goes, the less chance you have of making a lot of money. So that's a big mistake, is people looking at the news or looking at momentum or believing a rumor and investing in. Now, I've seen people put all their money in at one time. Nothing wrong with buying 100 shares or something like that if you can afford it. But again, keep an eye on it. And when it goes up, if you have a profit, lock some of that profit in. That's where the biggest mistake I see is people fail to take profits when they have a gain. And like I always say, you're not up until you're out.
Partner with a team that can get you where you want to be in retirement. Coach Pete and the team at Capital Financial are ready to help plan for retirement and implement strategies to make your savings last. Take advantage of the no-cost, no-obligation financial review to understand the ins and outs of your retirement plan. A customized plan based on your wants and needs. Contact us today. Also, be sure to like this video and subscribe to this channel for more retirement help.